Welcome back to the deep dive. Today, we are shining a light on, well, one of the most powerful, yet often kind of overlooked sectors of the global economy, electronics manufacturing services, or EMS. I mean, this is the massive, complex infrastructure that actually builds the physical tech that powers our digital lives, right?
Yeah.
Stuff in your car, the huge server racks for the cloud.
Everything. And for decades, this whole industry has operated under, let's call it the shadow of the commoditization trap.
Yeah.
It's all about high volume, but really razor-thin margins.
Yeah.
You live and die by efficiency, competing on pennies, basically, and you're constantly battling the huge negotiating power of the big tech brands you serve.
Exactly. So our mission today is to really deep dive into Jabil Inc., ticker JBL, and track their multi-year, pretty radical strategy. It's designed specifically to escape that trap.
That's the goal.
Jabil is actively pivoting away from being, just a low-margin assembler. They're transforming into a high-value engineering and design partner, and they're staking their future almost entirely on the biggest theme in tech right now, AI, the AI revolution.
And that transformation became, well, physically and financially undeniable in late 2023. Jabil executed this really strategic $2.2 billion divestiture. They sold off their high-volume mobility business.
Right.
And look, we're not talking about just selling off a factory here. This was like surgical removal of their largest but definitely lowest quality revenue source.
Wow.
This decision just fundamentally reshaped the company's entire revenue quality, its margin profile. It's the ultimate statement, really, that Jabil is prioritizing less revenue but much higher quality.
Okay, let's unpack that transformation then, because the moment that deal closed, it must have forced Jabil to completely rethink how it organizes itself, how it reports its business, everything.
Yeah, exactly. Starting officially September 2024, Jabil adopted a brand new three-segment reporting structure. And this is maybe the clearest signal yet that they know they aren't just one monolithic, cyclical electronics manufacturer anymore.
Okay.
They now have distinct economic drivers.
Right.
And this new structure gives investors, and you, the listener, much more immediate transparency. It's clearer.
So we can think of these new segments, maybe conceptually. It may help clarify the strategy. Like there's the growth engine,
Yep.
the resilient core, and the transitioning segment. Is that about right?
That's a perfect way to frame it, actually. This structure tells the market exactly where they expect their future profits and, their growth to come from.
Got it. Let's start with the big one then, the growth engine, intelligent infrastructure. This sounds like where the pivot really hits maximum speed.
Oh, absolutely. This segment is the future of Jabil, basically. It covers AI infrastructure, the huge build-out of cloud and data centers, sophisticated networking hardware, and also, crucially, capital equipment, the stuff used in the semiconductor industry.
Right.
These are all products defined by complexity, high performance, not simple stuff.
So for fiscal year 2025, this segment is already projected to be what, like 41% of Jabil's total revenue? That's about $12.2 billion. I mean, how explosive is the growth really here?
It's astounding. And the sources really highlight this with specific data points. In just the fourth quarter of fiscal 2025 alone, segment revenue surged by an astonishing 62% year over year.
62%. Wow.
Yeah, think about that for a second. 62% growth.
Yeah.
That's the kind of number you usually hear from, like high-flying software companies, right? Not manufacturers dealing with steel and copper and complex racks.
Sure.
This secular explosion is driven entirely by the demand for highly specialized AI hardware.
Okay, that growth rate is phenomenal, no doubt. But when you rely on such a hot new market, you inevitably face concentration risk, don't you? How significant is that risk in this high-growth engine?
It is substantial.
Yeah.
And it's really critical for us to acknowledge that. This one segment houses Jabil's single largest customer, a major hyperscale cloud service provider.
Okay.
And that single customer accounted for 16%, one-sixth the company's total net revenue in FY 2025.
16% from one customer.
Yeah. It shows you the depth of integration, which is good in a way, but it also creates immense volatility risk if that one customer just, pauses its spending for a quarter or two.
Wait a second. So the entire bull case, which is really relying on this structural margin improvement, it hinges on one hyperscaler continuing to spend aggressively on AI infrastructure. Isn't that just swapping the kind of inherent volatility of the low-margin consumer electronics market for the inherent, if maybe more profitable volatility of cloud spending cycles?
That is the essential trade-off. You've absolutely hit on the primary vulnerability there. However, the difference is the quality of the revenue. It's different.
How so?
Well, building a highly regulated, liquid-cooled AI server rack
Mm-hmm.
that's a multi-year, deeply integrated partnership. It commands superior pricing, high switching costs. Building a simple phone casing component, that's more like a transaction.
Okay.
So they swapped low-margin transactional volatility for high-margin partnership volatility. The risk is definitely still there, but the reward profile is vastly improved.
Okay, that makes sense. Let's move on to the stabilizing force then, the resilient core. They call this regulated industries.
Precisely. This includes sectors defined by really extreme requirements for quality, long product life cycles. Think healthcare and packaging, automotive and transportation, and renewables and energy infrastructure.
Right.
The beauty of these segments is the high barrier to entry. It's hard to get into these markets.
And what specifically creates that high barrier? Is it just needing a lot of capital or?
It's not just capital, no. It's regulation, it's compliance, and it's time. Think about medical device manufacturing. The facility has to be certified, the process is validated, the supply chain totally locked down and traceable.
Mm-hmm.
The regulatory hoops for, say, a new automotive component, that can take years to clear. So once Jabil is the certified provider, they are really entrenched. And that leads to predictable long-term revenue streams.
But even this core isn't completely isolated from the wider economy, right? Did they face macro headwinds in this area recently?
Oh, they absolutely did in FY 2025. The sources point out some notable macroeconomic softness, specifically a slowdown in global demand for electric vehicles, and particularly delays in those big utility-scale renewable energy projects. High interest rates, permitting bottlenecks, slowing things down.
Right, we've seen that. So despite those revenue pressures, how did the segment's profitability hold up? Did it prove resilient?
It did. It really proved its resilience. Even with softer volumes, the core operating margin hit 6.5% in the fourth quarter of fiscal 2025.
Still pretty strong.
Exactly. That proves the underlying cost structure is robust. They can manage costs and maintain premium profitability even when they aren't running at peak capacity, which is, essential for surviving those cyclical downturns.
Okay. Finally, we arrive at the transitioning segment, connected living and digital commerce. This sounds like where we see the remnants of the old Jabil, maybe, but now under a clear mandate for change.
Yeah, that's a good way to put it.
Mm-hmm.
This segment covers things like digital commerce, think warehouse and retail automation, along with their legacy consumer product lines that weren't part of that big mobility divestiture.
Okay.
And management is executing what they call deliberate portfolio actions here. Basically, this means they're aggressively pruning. They're exiting low-margin, high-headache consumer programs and focusing resources on higher growth areas like automation and smart retail tech.
Pruning usually means revenue shrinks, right? But what happened to the margins in this segment?
This is where the structural thesis is proven most dramatically, I think. The segment revenue did decline because of those planned exits, but the profitability soared.
Really?
Yeah, the core operating margin reached 6.6% in Q4 FY25. That represents a remarkable 210 basis point improvement year over year.
Wow, 2.1 percentage points.
Exactly. So when you cut the low-quality business, the higher quality stuff that remains shines through almost instantly. That 210 basis point jump. That's the quantitative proof that focusing on margin over just sheer scale is working in every part of the business now. #22. The structural transformation of the EMS industry.
Okay, so Jabil's overhaul is clearly a response to these massive industry trends. Let's maybe zoom out for a minute and look at the market scale, the structural transformation happening across the entire EMS landscape.
Yeah, it's important context. The scale is just immense. The overall EMS market was valued at over $600 billion in 2024.
600 billion.
Yeah, and it's not slowing down. Projections suggest it'll exceed $1 trillion by the early 2030s. It's fueled by two really powerful long-term trends.
Okay, what are those?
First is, everything's becoming smarter, right? The electronic content in every product, cars, appliances, medical gear, it's constantly increasing in complexity and value. Second, there's the continued, almost strategic necessity of OEM outsourcing. The original equipment manufacturers, the brands, they realize they just can't afford to be experts in complex global manufacturing and software development and R&D and marketing. It's too much.
So they outsource the tricky manufacturing part.
Exactly. They outsource the complexity, and that drives this crucial value chain shift. Traditional EMS was, pretty basic assembly, just screwing pieces together.
Right.
The leading providers now, like Jabil and its main peers, are moving into end-to-end solutions. This means taking responsibility for product design, early-stage engineering validation, complex supply chain orchestration, even aftermarket services.
So they're becoming much more integral partners, not just contract manufacturers building to spec. And I assume those integrated services command much better margins.
Absolutely. The technical complexity is the margin multiplier. If you can handle the design work, the verification process, you become indispensable.
Okay, let's talk about the key industry tailwinds then. The big forces making this pivot so necessary and potentially profitable. The biggest one, seems like without question, is artificial intelligence, AI, and high-performance computing, HPC.
This is just pure fuel injection for the entire industry.
Oh,
AI requires hardware that is fundamentally different from traditional corporate IT. We're talking about servers that draw immense amounts of power,
huge to power draws.
advanced networking equipment that transfers data at like light speed, and crucially sophisticated liquid cooling solutions to manage the intense heat density these things generate.
Okay, why is that shift to liquid cooling such a high-margin opportunity for manufacturers like Jabil? What's so special about it?
Well, because it requires microtolerances and precision that your average mass-market production facility simply can't meet. Air-cooled servers, that's pretty standard assembly.
Right.
Liquid cooling involves complex manifold design, managing fluid pressure, ensuring absolutely zero leaks under continuous operation, integrating custom piping within the server rack itself. It's complicated.
Yeah, sounds it.
This requires specialized materials, advanced testing protocols, and deep engineering know-how. Jabil's expertise here, which they boosted with their acquisition of Micros, moves them firmly into that indispensable partner category for their customers.
Okay. Moving on to the second major tailwind, supply chain regionalization. This seems like the ongoing consequence of geopolitics and, of course, the pandemic.
Yeah, this is perhaps the most expensive and profound shift happening on the factory floor right now.
Yeah.
You've got the geopolitical friction, particularly the U.S.-China trade stuff,
Still ongoing.
combined with the extreme vulnerability that COVID exposed in global supply chains. All of that has forced global OEMs into this China plus one strategy.
Yeah.
They simply have to diversify their manufacturing footprint. They can't rely solely on China anymore.
And what does that look like in practice? According to the sources, where is production moving?
It's a massive transfer of capability.
Hmm.
Estimates suggest maybe 30% to 40% of China-based production is migrating or will migrate.
Wow, that's a lot.
It is. This means huge investments in places like Mexico, Vietnam, Malaysia, India, and yes, also reshoring activities back in the U.S., often helped along by local government incentives or federal programs like the CGPS Act.
Right.
And Jabil's deep global footprint makes them a prime beneficiary here because they can offer customers that region-for-region flexible manufacturing almost instantly. They already have facilities in many of these places.
Okay, and the third major tailwind, this helps offset the cost of that regionalization, right? Industry 4.0 and automation.
Exactly. Look, if you're moving production from a low labor cost place like China to a higher labor cost area like the U.S. or Mexico, you absolutely must automate aggressively to maintain your margins.
Makes sense.
So this means manufacturers are heavily investing in smart factory technologies, robotics, AI-driven quality control, IoT integration for real-time efficiency monitoring, advanced materials handling the works. Jabil is basically using this necessity to become more efficient globally. They're accelerating their own modernization efforts, partly to combat the rising cost of labor in these new manufacturing hubs.
Okay, now let's balance that optimism a bit. Every complex transformation faces headwinds. What are the key challenges Jabil and the industry are dealing with?
Well, the first is just basic macroeconomic cyclicality. The AI boom is fantastic, sure, but Jabil still has significant exposure to consumer electronics, general industrial markets, especially the automotive market.
Right.
High inflation, rising interest rates. These things make consumers and businesses cautious. That creates demand sensitivity that can put pressure on their factory utilization rates, especially outside that booming AI segment.
And the political environment, as you mentioned, remains pretty fraught. Geopolitical and tariff risk is still a thing.
Absolutely. The persistence of those Section 301 tariffs, for example, creates constant cost uncertainty. Jabil and its peers have to continuously reconfigure their supply chains just to mitigate tariff impacts.
Sounds exhausting.
It's a massive, ongoing operational headache. It eats up management time and resources. They constantly have to decide, is it cheaper to just pay the tariff this quarter, or do we move the entire production line somewhere else? Sometimes multiple times.
And finally, there's the ironic cost of that regionalization tailwind you mentioned, the regionalization burden.
Yeah, this is the near-term pain for the long-term gain, essentially. Moving production requires huge upfront capital expenditure to build or retool facilities. But maybe more importantly, it requires a massive logistical effort to qualify new, often smaller local suppliers in these new regions.
Right, you can't just replicate the mature China supply base overnight.
Exactly. So for a while, you're kind of stuck running down capacity in your efficient legacy Chinese facilities while simultaneously spending a ton of time and money to ramp up these brand new, initially less efficient sites in, say, the Southeast US or Mexico,
Hmm.
successfully navigating that transition without severe margin erosion. That's arguably Jabil's biggest near-term execution challenge right
Yeah.
now. Hashtag Tag 3. Jabil's competitive moat and critical risks.
Okay, we've sort of established the structural environment they're operating in. Now let's see where Jabil actually sits in the competitive landscape. You said it's a highly consolidated field dominated by a few huge global players.
Yeah, the competitive dynamic is fierce. Jabil's most direct comparator is probably Flex. They operate at a similar scale, and they also have a strong focus on transitioning to these high-value markets like automotive and data centers.
Okay.
Then you have Sanmina. They're smaller, but they've carved out some really specialized, high-reliability niches. Think defense contracting, high-complexity medical devices. Though they're also rapidly chasing that cloud and AI infrastructure market, too. Everyone wants a piece of that.
But the peer that really seems to drive the narrative here, maybe from a valuation perspective, is Celestica, right?
Celestica is essential context, yeah.
Yeah.
They trade at a substantial valuation premium. Their price-to-earnings ratio is significantly higher than Jabil's.
And why is that?
Well, because they were early, and they were really singularly focused on manufacturing the high-speed data center switches and networking gear that are absolutely critical for AI.
Got it.
The market is unequivocally rewarding that focused kind of pure play exposure to the AI theme with a valuation premium, and that premium multiple. That is precisely what Jabil is trying to earn through its strategic pivot. They want that Celestica-like valuation.
Okay, so if the competition is that aggressive, what is Jabil's competitive moat? What makes their business defensible against these rivals?
I think it boils down to a massive self-reinforcing scale advantage, really. First, just economies of scale and global footprint. Jabil operates over 100 manufacturing sites in more than 25 countries.
Huge footprint.
Huge. And critically, their immense size gives them incredible purchasing power. They manage over $25 billion in annual procurement across more than 38,000 suppliers.
Wow.
That scale lets them secure favorable pricing for components and allows them to offer customers true multi-region flexible manufacturing capabilities that, frankly, a smaller competitor just cannot replicate.
Okay. Second, that pivot we talked about to being an engineering-led partner.
Yeah, this is all about moving up the value chain. Jabil isn't just waiting for a blueprint anymore. They're offering design services, prototyping, validation, advanced test engineering. They engage with their customers. They have over 400 leading brands at the earliest possible stages of product development.
And that early involvement creates stickiness.
Exactly. That early collaboration creates deeply integrated, sticky relationships. When Jabil helps design the manufacturing process alongside the product itself, the switching cost for that customer just skyrockets. It's hard to leave.
Which leads directly to the third point, high switching costs.
Yeah, I mean, think about the operational risk for a massive OEM, like one of these hyperscalers. If they decide to move their flagship server product line from Jabil to a competitor, they risk catastrophic supply chain interruptions, potential quality control issues, delays.
Yeah, disaster.
Right. That operational risk is a powerful barrier. These partnerships are inherently long-term. And look at the strategic relationship they hold with their largest customer. It's even evidenced by that Amazon warrant agreement,
Right, you mentioned that.
which allows Amazon to acquire Jabil shares under certain conditions. That depth of integration goes way beyond a simple supplier-manufacturer contract. It signals a real mutual commitment to strategic alignment.
Okay, let's address the elephant in the room again, though. The primary vulnerability seems to be this customer concentration risk.
It's an unfortunate reality of the EMS industry, yes, especially as the biggest tech companies themselves consolidate market share.
Hmm.
Think Amazon, Google, Microsoft dominating cloud.
So the numbers are still stark.
Jabil's reliance is clear. The top 5 customers account for 36% of net revenue. And as we established, that single hyperscale cloud provider, 16% of total revenue, all concentrated in that critical AI segment.
So the argument remains that while the risk is definitely high, the nature of the risk has fundamentally improved. Is that the right way to think about it?
Exactly. They essentially exchange concentration risk in the highly cyclical, margin-destroying consumer smartphone market.
Yeah, the mobility business they sold.
Right. For concentration risk in the strategically critical, high-growth, higher-margin AI infrastructure market. Now, if that big AI customer spending slows down, it will hurt, no question. But the revenue they'd be losing is premium revenue, not commoditized stuff.
Okay.
Furthermore, the AI spending cycle, while it's still cyclical, is often driven by massive, multi-year strategic capital expenditure plans. So, arguably, it might offer better predictability than, say, seasonal consumer product launches, which can be very volatile.
Okay, the strategy is compelling, the industry trends seem supportive, but the numbers have to prove the thesis, right? Let's look at the quantitative evidence of this new Jabil's financial health, starting with revenue resilience.
Yeah, the revenue trend actually chronicles this strategic shift perfectly. Jabil peaked in fiscal year 2023 at $34.7 billion in revenue. In FY 2024, revenue dropped sharply, down 16.8% to $28.9 billion. Now, that wasn't an economic failure. That was the direct, expected, and planned result of selling off that multi-billion-dollar mobility business.
Right, they chose to shrink.
The deliberately sacrificed scale for margin.
But the recovery in FY 2025, that shows the strength of the remaining parts of the business.
It really does. Revenue rebounded to $29.8 billion in FY 2025. That's a 3.2% year-over-year increase. And the significance here is that this growth was achieved despite the structural headwind of, losing all that mobility revenue, and despite that persistent cycle of weakness we talked about in other key segments like automotive and renewables.
So the AI part pulled everything else along.
Essentially, yes. The explosive strength in the intelligent infrastructure segment was more than sufficient to power past those drags. It proves the new, higher-quality portfolio is resilient and capable of generating growth, even with headwinds elsewhere.
Okay, now let's get to the real centerpiece of the entire transformation, the margin story. Historically, operating margins were, let's face it, notoriously low in this industry. What's the structural improvement they've achieved?
This is the metric that matters most, I think. Jabil's historical GAAP operating margins, if you look back from, say, 2015 to 2019, they were consistently stuck in that narrow 2% to 3% range. Pretty thin.
Very thin.
The goal of this entire pivot was to lift that floor permanently. And they've done it. The company's core operating margin reached 5.4% in FY 2025.
And the old range.
Right. And they're confidently guiding it to expand further to 5.6% in FY 2026. This sustained 200-plus basis point expansion, that's over 2 percentage points, is the core of the bull case. It represents a fundamental, positive, and likely irreversible shift in the company's basic earning power.
Okay, I want to spend a moment, though, on this necessary distinction between Jabil and core metrics, because there's a pretty significant divergence here. Investors, often get suspicious when companies rely heavily on non-GAAP metrics.
That's a totally valid concern, and we absolutely have to scrutinize it. In FY 2025, Jabil reported $1.2 billion in GAAP operating income, but $1.6 billion in core operating income.
That's a $400 million gap. That's huge.
It is enormous.
Yeah.
Management uses the core metric because, they argue, it strips out one-time, non-recurring charges directly related to the transformation itself. Things like restructuring charges, costs associated with selling off mobility, and costs related to setting up these new regionalized supply chains.
But shouldn't investors worry if those restructuring costs keep recurring? I mean, that regionalization burden, for instance, sounds like an ongoing cost over several years, not really a one-off item.
That is the essential challenge in evaluating Jabil right now.
Yeah.
You have to ask, is the transition truly over? Management argues that these costs are necessary investments to create the new 5.6% margin profile, and that once the new facilities are fully ramped up and efficient, these charges will taper off significantly. Therefore, they say, the core metric, which focuses on the profitability of the underlying reshaped business, is the best predictor of future earning power.
So the bet is they hit that 5.6% target sustainably, and those extra costs fade away.
Exactly. If they hit that 5.6% target and those transitional costs start to disappear from the GAAP numbers over the next year or two, the market will likely reward that confidence heavily.
Okay. Let's talk about capital efficiency and cash flow. Is this AI build-out going to require Jabil to just spend huge amounts of capital constantly just to keep up with demand?
Surprisingly, the answer seems to be no, which is actually a major positive for the story. They appear to be managing this growth pretty efficiently. Their capital expenditure, or CapEx, is anticipated to be only about 1.5% to 2.0% of net revenue in FY 2026.
That sounds low for a manufacturer growing this fast.
It is quite low. It means they can fund their massive growth with relatively modest spending compared to revenue, and the return metrics look excellent. Reported return on invested capital, ROIC, is 17.5%, which is solid, but the core ROIC they report, it was a fantastic 54% for FY 2025.
Okay, 54% core ROIC. What does that tell us in plain English?
It means that the high-value businesses Jabil chose to keep and grow, particularly that AI segment, are extremely effective at generating returns from the capital invested in them. Every dollar they put into the core business generates 54 cents of profit if you exclude those transitional restructuring costs.
I see.
This is just not the profile of a sluggish, capital-intensive legacy manufacturer. It's much more efficient.
And all of this efficiency and margin improvement culminates in their cash flow machine.
This is really the engine that drives everything else, the buybacks, the M&A. Jabil generates consistent, predictable free cash flow, FCF. They generated over $1.3 billion in adjusted FCF in fiscal 2025.
1.3 billion.
And importantly, they've guided for the same strong amount, over $1.3 billion again in fiscal 2026. This consistent, massive cash flow is the fuel for everything else they want to do. M&A, capital investment, and especially shareholder returns. #CHAGV. The growth strategy and capital allocation.
Okay, so with over $1.3 billion in annual free cash flow coming in, where is Jabil strategically investing this capital to make sure they actually capture that AI wave effectively?
Well, their investment in the AI future looks pretty proactive and targeted. Jabil is projecting approximately $11.2 billion in AI-related revenue for FY 2026 alone.
Huge number.
Huge! And to secure this growth, they're making tangible commitments. That includes a planned $500 million multi-year investment specifically to expand their manufacturing footprint in the Southeast U.S.
Okay, why the Southeast U.S. specifically? Is it labor?
Incentives. It's mostly strategic proximity, it seems. Many of the big cloud and AI data centers are being built across the U.S. South and Eastern Corridor. Manufacturing these complex server racks physically near the deployment sites reduces logistical costs, it simplifies supply chain security, and aligns perfectly with the customer's own regionalization demands. Closer is better.
Makes sense. And what specific capabilities are they actually building in these new or expanded facilities? Is it just more assembly lines?
No, it's focused on the highest complexity areas.
Mm-hmm.
Things like advanced power solutions critical for those power-hungry AI chips, advanced cooling technology, as we discussed earlier, likely leveraging that Micros acquisition. Yeah. And complex rack integration.
What does that involve?
That's where they essentially assemble, test, and fully validate entire server racks before they are shipped to the hyperscaler customer. Ready to plug in, basically. This level of complexity and value add is precisely why they can charge higher margins than just building components.
Got it. Next up, the second pillar of their strategy seems to be strategic M&A for diversification, focusing on bolt-on acquisitions that raise the barriers to entry in their key segments.
Yeah, they're using M&A smartly. The acquisition of Pharmaceutics International, Inc., PI, in early 2025 is really a textbook example of this. This moves them squarely into the high-margin pharmaceutical CDMO market.
CDMO.
Contract Development and Manufacturing Organization. This is a dramatic step up from simply manufacturing standard medical devices. Pharma CDMO involves handling highly potent active pharmaceutical ingredients, sterile packaging, navigating extremely stringent FDA and global regulatory pathways. It's very complex, very high stakes.
So this PI acquisition isn't just about adding revenue. It's a strategic move to dramatically increase the barriers to entry for that entire regulated industry segment, makes it harder for competitors to follow.
Precisely. It deepens their competitive moat and helps ensure their resilient core remains resilient by making their capabilities much harder to replicate, especially for demanding pharma clients.
Okay. Finally, let's look at their highly explicit shareholder-focused capital allocation. How are they actually using that $1.3 billion plus in annual free cash flow?
Well, the stated philosophy is very aggressive, actually.
Yeah.
Jabil targets returning roughly 80% of its operating capital to shareholders over time.
80%, that's high.
It is. And the centerpiece of this commitment right now is share repurchases, buybacks. They've aggressively bought back stock, reducing their total share count by over 10% in the last year alone.
Wow.
This sustained large-scale buyback program is a really powerful signal of management's conviction that their own shares are undervalued relative to the future cash-generating power they see in the transformed business. And they backed this up pretty recently, authorizing a new $1 billion share repurchase program in July 2025. They're putting your money where their mouth is, #TagExistence, conclusion and synthesis.
Okay, so after tracking Jamil all the way from the sort of low margin basement of consumer electronics up to the high stakes, high margin world of AI infrastructure, let's try and summarize the investment case. What is a powerful bull case here?
The bull case rests entirely on the successful execution of this massive strategic pivot. Jabil is now, arguably, a fundamentally higher quality business. It's become a critical picks and shovels provider to the AI gold rush.
Right.
And that strategic shift is driving what looks like irreversible structural margin improvement, moving from that old 2–3% range consistently up to the guided 5.6% plus range. This transformation generates robust, predictable free cash flow, over $1.3 billion annually. And importantly, compared to high-flying peers like Celestica, Jabil still offers compelling growth at a reasonable price, or GP. It trades at a much lower valuation multiple while exhibiting pretty strong growth drivers.
Okay. And what are the key risks? What's the bear case that could potentially derail this impressive story?
Well, the primary risk remains that persistent concentration risk. We keep coming back to it, but it's crucial.
Mhm.
If that handful of hyperscale cloud providers decides to significantly pause or curtail their capital expenditure, and history shows they do go through cycles, it would have an immediate and severe impact on Jabil's biggest and most important revenue segment.
Yeah.
Furthermore, the company still faces that persistent cyclical weakness in the massive automotive and renewable energy markets. And they absolutely must flawlessly manage the complex, costly execution risk associated with the ongoing restructuring and building out that new global regionalized manufacturing footprint. Lots of moving parts.
We should probably mention management and governance quickly before we conclude, as executing a transition this massive obviously requires stable, experienced leadership.
Yeah, stability is essential here. The leadership team, including the CEO, Michael Dastor, is experienced and generally long-tenured within Jabil. Dastor, importantly, was the former CFO, so he was really the architect of the financial strategy designed to achieve these higher margins.
Okay.
We should also note the planned orderly leadership transition scheduled for January 2026. The long-serving executive chairman, Mark Mondello, who was CEO before Dastor, is planning to step down then. This orderly process, combined with Jabil's solid investment-grade credit rating, signals financial prudence and stability during this critical transition phase.
So wrapping it all up, what is the final assessment of Jabil in 2025? Where do they stand?
Look, it is a truly transformed company. They successfully shed the baggage of their lower margin past and committed fully to the future of high-complexity manufacturing, especially around AI. Their future success, their future margins, and ultimately their stock performance hinged almost entirely on their ability to consistently sustain that 5.6% plus core operating margin floor
Maintain those gains.
and the continued flawless execution of that AI growth trajectory. They took a huge, calculated, multi-billion-dollar risk with the divestiture and the pivot, and so far, the execution seems to have proven the core strategy correct. But the execution needs to continue. #tagoutro.
Okay, that brings us to our final provocative thought for you, the listener, to consider as you digest this deep dive.
Yeah, our source material really confirms that this geopolitical friction trade policy risk, it's forcing global companies to relocate manufacturing at immense cost. It's driving that China plus one strategy and boosting investment in regions like the US and Mexico.
Right. So the question to chew on is this. When manufacturing moves from low-cost regions to higher-cost labor regions, does that simply lead to a globally more expensive, less efficient supply chain overall just because basic costs go up?
More.
Or will the very necessity of relocating to places like the Southeast U.S. force manufacturers like Jabil to aggressively accelerate the deployment of Industry 4.0, more robotics, more AI-driven factories to the point where that automation actually offsets the rising labor costs? Could it ultimately create a more technologically advanced, albeit more decentralized, global manufacturing network sooner than we ever expected?
It's that ultimate industrial trade-off, isn't it?
Yeah.
Geopolitical risk may be forcing technological acceleration. What will the final price tag be for consumers and the economy? We'll leave that thought with you.
Until next time, keep digging deeper.